On October 1st, the US government shut down. If you live in Europe and invest in Donald Trump's America, pay attention. As a professional investor with 18 years of experience, including both on Wall Street in America and here in Europe, I'm very concerned about what's coming. Okay, but what just happened? Well, every year, the US Congress has to pass spending bills by October 1st to fund normal government functions. Historically, this has been a routine thing. Congress has already decided to spend the money, so they just approve the spending. But in recent times, these spending bills have become opportunities for political parties to hold the government hostage in order to achieve their goals. Time after time, Republicans and Democrats have been locked in a fight with a high risk of the government shutting down. And a few times over the past years, it has actually happened. For example, in 2013, during the Obama presidency, and in 2018 and 19, during the first Trump presidency. Now, when the US government shuts down, what does that mean? Well, a government shutdown means that non-essential government offices are closed. Many employees are furloughed. This means they stay home without work and without pay. Depending on the length of the shutdown, this can have a direct economic impact, but usually it's limited because those employees get back pay after the government restarts. But this time, Donald Trump has actually threatened to use this crisis to permanently fire many employees.
We can do things during the shutdown that are irreversible, like cutting vast numbers of people out.
If that happens, the impact could be worse, but we will see. Now, during a shutdown, government offices that publish statistics about the economy are also closed. So there is more uncertainty in the markets, and that can mean more volatility in stocks and bonds. What a government shutdown does not mean is that the U.S. stops paying its debts. The U.S. does keep paying interest and principal on government bonds because that money doesn't have to be voted for every year. In this way, government shutdowns are less risky than so-called debt ceiling crises. These crises do have a risk of default, and we'll talk about that in a second. So overall, the actual short-term impact of a government shutdown on the stock market has usually been pretty minor. And there's no reason to think that this time it's going to be massive. If that's true, then why am I worried? Well, if this were the only problem that we've seen from America this year, I wouldn't be concerned. But it's just the latest symptom in a concerning sequence. From Donald Trump raising tariffs dramatically on foreign partners in April, to the Trump administration threatening to tax foreign investors heavily, to using these draconian measures to deport not just immigrants but visiting workers from America, to waffling on America's military commitments around the world. Basically, America has become much less predictable financially, politically, and militarily. And it has also become a lot more dependent on a single point of failure, a president who has consolidated more and more power in his hands. So what does this mean for investors? Well, first of all, I need to point out the elephant in the room. Almost nobody is talking about this. People are pretending it's not a problem, but I think it's ridiculous. The US government is no longer a reliable financial entity. For decades in finance, when people talked about a risk-free investment, the safest possible investment, everybody meant US treasuries, government bonds backed by America. Everyone around the world, from private individuals to companies to pension funds and sovereign wealth funds, is heavily invested in US treasuries. And everybody's acting like it's a risk-free asset. But looking at the current situation, I think that is clearly not true. The risks may not be very high, but they are there. They're not just theoretical. There have been several US government debt ceiling crises over the past few years. What happens is that every few years, Congress has to approve increasing the US debt limit so that America can keep borrowing in the markets, so that it can repay its already issued bondholders. And this has also become an opportunity for bitter political fights among Republicans and Democrats. There have been major debt ceiling crises in 2023, then back in 2013 and in 2011. In each case, the US government came this close to at least a short-term default on its obligations. If a few senators or congressmen had not compromised, the US would have defaulted. Now, so far, every time they manage to avert the crisis. But if this kind of situation keeps happening again and again and again, and if you have highly polarized politics and unpredictable people like Trump in the White House, it is very plausible that one of these times they will step over the edge and a default will actually happen. That risk is not zero. It's not even 0.1%. I believe it's significantly higher. There is a reason major rating agencies like Standard & Poor's and Fitch and Moody's have all downgraded their ratings of U.S. debt in recent years. Now, does this mean that U.S. government bonds are a high-risk investment? Of course not. Even if there's some kind of short-term default, I believe it's extremely unlikely the U.S. government would simply refuse to pay its bondholders. I mean, that would be a crazy, crazy situation, very unlikely. But U.S. government bonds are not risk-free assets, so you should keep that in mind if you're investing in them. I know a lot of European investors who've been buying U.S. government bonds because they have read American books and watched American videos, and they think it's the safest thing in the world. And sometimes European investors do this even while taking on currency risk. They live in the Eurozone, but they're buying U.S. government bonds in dollars without hedging. They're taking on significant currency risk just to get this safe asset. Now, if you're doing that, I would think about it very carefully. For my money, I would rather have German government bonds in my portfolio than American bonds. Although, of course, they don't pay as much. The second problem is the quality of the U.S. stock market. For decades, the U.S. stock market has been a shining example of a developed world market. It's governed by the rule of law, it's transparent, it's reliable. It's everything a stock market is supposed to be. But in recent years, and especially since Trump took office for the second time, I'm starting to look at the U.S. market more like an emerging market, not a developed market. Now, why is this? It's because emerging markets are characterized by breakdowns in the rule of law, by corruption issues, and by the ability of one figure or one party to massively impact companies or entire industries, and of course, investor profits. And to me, that description actually sounds a lot like Donald Trump's America. Does this mean that the US stock market is a bad investment? Not necessarily. For example, the Chinese stock market has earned a lot of profits for a lot of foreign investors, even though it's clearly an emerging market with a huge influence from the leader of the Communist Party. But the point is, emerging markets have a different risk profile than developed markets, and if you're investing in them, you should be aware of it. And this leads me to the third problem that I see with the US market, which is lack of diversification. This is actually twofold. First, we've been talking for years about how the S&P 500 has become rather concentrated. The top 20 stocks make up around half of the total market capitalization. The top 10 tech stocks are like 30% of the whole market. Now, if this is your main concern, you could solve it by investing in US small cap stocks instead of these big tech companies, okay? But today we have a second source of reduced diversification in America. This is a systematic risk that all US stocks are exposed to, and its name is Donald Trump. In a normal democracy with a strict rule of law, it doesn't really matter that much who is president. When you're investing in 500 different companies in different industries, you have excellent diversification. They're going to move up and down at different times. But that diversification becomes significantly worse when all of those 500 companies are directly exposed to the decisions of one stable genius. I've always felt that simply buying the S&P 500 is kind of a risky bet. It has been a really successful bet over the past few decades, but it's been quite risky. Today, I feel that even more strongly. So, what are my conclusions for European investors? First of all, keep your eyes open. Realize that America is not what it used to be. US government bonds, while still quite safe and reliable, are not a risk-free investment. A stock portfolio that is 100% US stocks might not be as diverse as you think. Second, given the problems that we're seeing, the tariffs, the government shutdown, the extreme politics, you should be ready for major market disruptions over the next decade. I'm not saying there's going to be a crash. A crash could happen this year. It might not happen for another 5, 7, or even 10 years. Market crashes are extremely difficult to predict. But given all the risks that we are seeing, you shouldn't be too surprised if it does happen. That means make sure you are prepared. Have a safety cushion that's sitting in the bank. Make sure that the risk level in your portfolio is appropriate, that you have a good mix of stocks and bonds given your age and how much risk you're willing to take. Now, should you pull your investments out of America? I'm always hesitant to recommend ideas like that. For long-term passive investors, history shows it's best to pick a long-term strategy and then stick to it, and not look at news too much, not be influenced by all these political changes. In my own case, I already have a globally diversified portfolio. I also have a lot of assets here in Europe because of my business, so I'm not planning to make changes. That said, given everything that we're seeing, I would not blame somebody. I wouldn't think that you are foolish if you did rebalance away from America at least a bit. At least you're doing it now, while the stock market is doing well, not in the middle of a crash. Now, if you do rebalance away from America, be aware that this is about reducing America-specific risk. This is not guaranteed to give you more profit. America might keep outperforming for years. All the big AI and tech companies are in America. But if you want to reduce the direct impact of Donald Trump and US government dysfunction on your investments, then I think that rebalancing away from the US, putting less in the US stock market, can make sense. Now, the next few months and years will be critically important for investors. If you're not a finance professional, it can be hard to keep up with everything that's happening. When you see some scary headlines, it is difficult to know, should you react to this or should you just stay calm and keep investing? This is why I send out an investment newsletter for Europeans every week. I cover investing insights and important news that all investors should know. If that sounds useful, follow the first link in the description to sign up.